Today we are going to talk about employee stock purchase plan, and typically known as the ESPP. So let's see what an employee stock purchase plan is. An employee stock purchase plan allows the employees to use after-tax payroll deductions to acquire company stock at a discount. This is a perk which is offered by a lot of tech companies, a lot of public companies, and it's just another kind of benefit that the companies offer. So two things to remember is that it's an after-tax payroll deduction. So unlike some of your other benefits like your pre-tax 401k or your medical insurance premiums and everything, this money is deducted from your payroll after tax. So there is no tax benefit at the time of deduction or when the deduction is made. And then you can acquire the company stock at a discount. The discount percentage is decided by the company. Typically what we have seen, it ranges from somewhere from 5% to 10%. There is various period where the discount percentages could be applied. It could be just discount on the purchase date price. It could be discount on the grant date price. And some companies offer a discount on the look back period or a period of time where they take the minimum price of the company stock during that period and offer a discount at that time. So let's look at some of the things you should know about employee stock purchase plan, some of the basic things. So moving on to how does it work? So let's take an example. Company X offers a ESPP plan. Similar to your benefit enrollment period, there's going to be an enrollment period. So if January 1st, the enrollment period begins, then you'll have probably typically 30 days or 60 days or 90 days to enroll into the ESPP plan. In our example, if the enrollment period is 90 days, so January 1st to March 1st is your enrollment period, and it has a start date and a deadline, similar to your benefit enrollment. Now, March 1st, which is now called the offering date or the grant date. So these terms are used interchangeably. So some company documents would say offering date, some would say grant date. This is the date. If you have enrolled into the ESPP program, this is the date when the deductions will begin from your paycheck. So you will start seeing, when you look at your pay stub, you will start seeing after all the pre-tax deductions, you will see a post-tax deduction for your ESPP. Now, typically from the offering date then to the purchase date, there's a 6-month window. So for 6 months, the company keeps deducting money from your paycheck. So if you enroll into this program and say 10% of your salary gets deducted, so they will deduct that 10% and keep that into an escrow account. And at the 6-month date, which is the purchase date, is when the company is going to purchase the shares and deposit into a brokerage account for you, which the brokerage account typically could be held at a custodian like E-Trade or Morgan Stanley or any of those custodians. So it is actually at the purchase date when the stocks are bought for you and deposited into your account. Now, let's see how the discount works. So let's look at an example of Company X offering a 15% discount with look back. So again, from our previous chart, January 1st is the enrollment date. March 1st is your offer date or the grant date. You enrolled into the ESPP program. The share price on the offer date is $10. Now, once you enrolled for 6 months, the company is going to keep deducting from your paycheck, putting it into an escrow account. And now on purchase date, they're ready to purchase the shares. So at what price are you going to get the shares? So if this company is offering a 15% discount with look back, they're going to see what was the price of the share on the offer date and what is the price of the share on the purchase date. If the price on the share on the offer date was $10 and on the purchase date was $15, you're going to get a 15% discount on this $10. So essentially, you are going to get the shares in your account at $8.50. That's going to be a cost basis, and that's very beneficial because the purchase date price is $15, and you have instantly earned or made a profit of this amount instantly by participating in this program. However, if the share price on the purchase date is lower than $10, which is say $8, you're going to get a 15% discount of $8, and you're going to purchase the price for $6.80 in that case. So you see, it totally depends. The amount of discount you're getting could be higher than $15, or the minimum it could be not $15, 15%, or it could be 15% on the purchase date price. So it totally depends on the share price at purchase date and offer date. Now, typically, to get the full tax benefit for ESPP, all the companies have a provision that they would want you to hold the shares for 2 years from grant and 1 year from purchase, and that is what your holding period would be. So in this case, the first time to get your full tax benefits, the first time you could sell these shares that were purchased in your account were on March 2 years from March 1st. And you have to satisfy both of these conditions. So 2 years from grant and 1 year from purchase. So that's how it works. This is an example of a 15% discount with look back. There are companies that do not offer look back period, and they'll just probably give you a discount on the purchase date. Or the companies could come up with some other form of discount. So make sure you're looking at your grant documents for all the details. Now, let's see, should you participate in the ESPP? Because this is all great, but does your situation allows you to participate in the ESPP? So we have a very simple decision framework that we think is helpful when you're trying to make this decision. Let's go step by step. Number one, do you have excess cash flow? So hopefully after you're on a month-to-month basis, you are seeing your income is exceeding all your expenses and you are seeing some excess cash flow. Now, before we even do anything, we want to make sure that you have enough cash savings for your short-term needs. It could be your property tax prices or a small vacation that you're planning to take. Make sure you have enough cash saved for all your short-term needs. You have max funded your emergency fund, which again could be somewhere, depending on your situation, it could be 3 to 6 months of your non-discretionary expenses plus some discretionary expenses. After you have maximized your short-term cash needs, let's see if you're funding your retirement savings or your 401k plan. Before you move on to the ESPP, things that you should start funding is your 401k plan. If you have kids, trying to put away some money for their education, if you intend to fund that, then putting some money for your 529 plans. Also, we want to make sure you are putting in some money outside of your retirement accounts and into a brokerage account on a monthly basis or maybe quarterly basis, depending on your cash, how your situation allows. And after you have done all of this, still, if you have cash left, it's great, and you can participate in the ESPP and take advantage of the discount that your company is offering. But if you haven't done all of this, we highly recommend not to do that. Now, once you participate in the ESPP, are there any risk involved? Yes, as with any financial situation, it's always a risk and return trade-off. So let's look at the risk. What are some of the risks associated with participating? So after the purchase date, your stock could go down. So that's a risk that, you were planning to hold the stock for 2 years. The stock price goes down, similar to probably the end of 2022. That happened to a lot of companies. The stock market was down and most of the company stock went down. For tech companies, it was as down as much as 30%. So it could go down. Again, your capital is tied for 2 years. So if you plan to take full advantage of all the tax benefits, your capital is tied for 2 years. Then the third risk, and I think it's a big one to consider, is concentration rates. So concentration risk, not just because you're heavily invested in your company stock, you could have other forms of equity compensation. Your companies could give you RSUs, or you might have ISOs, and you have all this money that is tied to this one company stock. Also think of it, your biggest asset is your human capital. And while working for the company, you are already exposed to some kind of concentration risk. So when you're making the decision to participate or not participate in a ESPP, keep in mind all these risks. ESPP taxation can get very complicated depending on how long you want to hold it. So we're going to cover the tax treatment of ESPPs in the next video. And again, as always, this video is made for educational purposes only. If you need personalized advice, please contact your advisor.